Welcome to the Corporate Treasury 101 podcast. In this episode, we have a fascinating discussion lined up on capital management, the future of working capital management, and much more. With us are the two founders of IOTA, Stefan M. Ciesla, co-founder at IOTA, and Gordon McKenzie, CTO and co-founder at IOTA. Stefan brings his expertise from his previous roles at FIG Corporate Finance and as Chief of Staff at Bankable, while Gordon McKenzie has a background as a clinical entrepreneur at NHS England. Together, they bring a very interesting blend of knowledge around capital management and technology. Our conversation with them was truly captivating, and we're excited to share it with you. In the episode of today, expect to learn what is working capital management, why is it important for companies, what is the role of a corporate treasurer when it comes to working capital management, what could be the role of AI in working capital management, what is a treasury policy, what does IOTA do, and much, much more. Their knowledge and passion for the topic were truly inspiring, and we really enjoyed our discussion with those two. We hope you will enjoy it as well. If that is the case, please consider leaving us a review on your favorite podcast app. It only takes 2 seconds, and your support means the world to us, and it helps the podcast thrive as well. Last but not least, we started the AI Treasury Insights newsletter, a bi-weekly 3 to 5 minutes read that covers what is happening in the world of AI in Treasury and how this technology will change the way we do corporate treasury. Follow the link in the description or simply type in your browser corporate-treasury-101.com/newsletter. With all that being said, please welcome Stefan and Gordon.
Stefan, Gordon, thank you so much for coming on the Corporate Treasury 101 podcast. Great to have you. Super excited to dig into it. We've touched on working capital management in the past on the podcast. Guillaume explained it to me really, really well, but that was a bit of a time ago now. So could you start off by just taking us through what working capital management is and why it's important to companies?
Yeah, sure. I mean, if you were to kind of try to summarize this in a relatively simple way, it's really a set of processes that are ultimately aimed at maximizing cash flow. And I think if you kind of want to go a little bit deeper, some of the key aspects would probably include managing your inventory and customer billing and collections to kind of realize cash inflows, and then accounts payable to essentially optimize the timing of cash outflows. And why is it important? Well, I guess it's generating cash is the bread and butter of every company, and that's the ultimate goal. So a well-designed working capital management process helps companies to maximize the cash that they generate organically, and it, all else being equal, should lead to a lower requirement to access external financing, which is more expensive.
So it's like making sure that the companies manage their inflows and outflows and balance it correctly. I remember there was short-term versus long-term in that as well. Is that is that how timeframes work? Or because cash can be, money's coming in and out on a minute-by-minute basis in a lot of companies, right? Are you really looking at that level of detail, or is it on a day cycle? How does that work?
Yeah, I guess it depends on the company. Many companies might look at working capital management on let's say a weekly basis, and sometimes daily. If you have a very fast cash cycle, you might look at it intraday as well. I guess, if you think about a balance sheet, all the assets which are classified as short-term assets and all the liabilities that are classified as short-term liabilities, usually that means less than 12 months, are typically included in working capital. And I mentioned receivables, inventory, payables, but there are also other aspects to it. And a lot of them are dependent on your business model.
I remember this 12-month mark thing that you mentioned when you taught it to me the first time and to everyone else. So what's the role of a treasury department specifically in that process? Company?
Great question. Again, I think it slightly depends, but typically Treasury plays an oversight role, and they will work very closely with teams that kind of manage each strand of working capital. So, for example, they will often interface with colleagues in credit control or accounts payable or procurement to make sure that all these processes are done in a timely manner. And I think that's important because Treasury is essentially the function that has the broader perspective and the broader view of this. And they also understand how all these processes ultimately tie back to financing of a company.
Okay. And we've been through a lot lately, right? Over the last couple of years. We had a pandemic. We have quite a changing and evolving macroeconomic environment. I'm thinking about the Russia-Ukraine war, the commodity prices going over the roof. Overall, the market is more and more uncertain and volatile, right? So how should Treasury and actually finance professionals, because I don't think only Treasury is impacted by this, right? How do professionals should look working capital management now?
Yeah, this is a very interesting question, and it's very topical. I think if you look at the current macro environment, in totality, this leads to essentially cost of capital increasing. And if you think about it that way, then managing your working capital in an efficient way is essentially a way to reduce your financing costs. As I mentioned at the beginning, to the extent you can maximize cash on hand for your organic operations, you don't need to access as much external financing, which in the current environment is only going up.
Yeah, it's a very good point you make here. So if that allows you to have cash more easily accessible, you don't have to borrow them at amazing interest rates going over the roof, right? So you can fund your activities yourself and not go to the banks charging interest because of the environment, right?
Absolutely.
Do you think it's a trend that is meant to continue, or is it just once in a lifetime?
Yeah, great question. I'm not an economist, but I take a keen interest in this. I think it's probably very difficult to foresee. Some of those factors that impact the current macro environment that you mentioned are probably, well, we hope, temporary in nature. So, with some of the geopolitical pressures easing off, hopefully that should also lead to, for example, energy prices coming down. But at the same time, this is a pretty big question that many finance professionals pose to themselves right now. Because if you think about what's happening around the world, around some of the trends like deglobalization, frictions in supply chains, that doesn't necessarily need to go away. With, for example, hopefully the war in Ukraine ending as soon as possible. And if you think about deglobalization and supply chains, that's really closely related to commodity prices, has a big impact on FX risks, and ultimately that actually influences central bank policy as well. So there are a lot of interrelated processes that in totality might mean that we could find ourselves living in a higher interest rate environment for longer.
Okay, super clear. Thanks for that, Stefan. I'd like also to liaise it with multiple recent surveys that are going out lately. They all seem to be indicating that cash flow forecasting and working capital management is at the top of the agendas of CFOs and treasurers. What are your thoughts on that?
Yeah, I think that's totally unsurprising given what we just discussed. Forecasting is to an extent a prerequisite to efficient working capital management, because unless you understand, what demand you're likely to face, when exactly your different cash inflows are going to take place, and also when you should expect your outflows to take place, it's very difficult to put processes in place to manage that in a kind of optimal way. I think we noticed a couple of interesting things on the forecasting side of things. So you're right. If you ask a treasurer or a CFO about this, they tend to agree that it's a top priority. There are also some surveys which suggest that at the same time, many CFOs and treasurers consider their own organization to actually be very good at forecasting. Indeed, we read a recent survey which suggested that between 70 and 80% CFOs consider their own process to be best in class. And I think it probably makes sense to a large extent, especially if you're thinking about slightly larger companies, because traditional forecasting is actually a pretty well understood process, in my experience, and many companies have done pretty well at mastering that. And I think that the next step is really to kind of think about how forecasting feeds into broader working capital processes as opposed to being a distinct field.
So what do you mean by that? Like, as a distinct field, do you see like a specific department dedicated to that?
Well, yeah, it's something we spend a lot of time thinking about here at Iora. So if you think about how this is being done in the companies today, forecasting is seen as a kind of distinct process within the Treasury team that people undertake. What we're quite interested in is, instead of looking at it as a slightly separate question, is can you actually, for example, feed forecasting to be just a feature of a process? So to give you a concrete example, there's more and more talk about the objective-based forecasts, which form an integral part of, for example, like a smart AP system that essentially undertakes certain forecasting activities in order to achieve a very specific goal that it does, as opposed to creating a forecast for a general purpose.
Okay, so the survey you mentioned, Stefan, I'm interested into having a look at it. So we'll put the link in the description so people can actually consult it, because that's very good insight. And yeah, overall, people want to know where their money is, right? That's more
absolutely.
That's more or less the idea. Yeah, makes sense. So what are the solutions out there on the market that can help corporate treasurers in the management of their working capital? What's out there right now?
Well, the tech landscape is evolving. There are actually a number of interesting solutions out there. Many of them are kind of predicated on what we call kind of seamless execution. So oftentimes that means that these are essentially payment systems which help to move money either in or out of a company. And this is a space that has seen a lot of evolution. There are a number of kind of incumbent players in the space, but you also have an increasing interest from upstarts trying to disrupt these different kind of subdomains.
Okay, and could we call it enough? Like, is the offer out there able to support the requirements of treasurers, but also, I'd like to say, the evolving needs and requirements, right? As per those priorities that we just broke down. Is it enough?
Well, it's certainly helpful, and many of these tools they're a great job at what they're designed to do. But I think it also depends on how you kind of want to look at digitalization within working capital management, because working capital management is not just about execution. If you think about payments, that's actually just a culmination of a much more intricate process that takes place in order to get money moving from one place to another. So, we think that if you're trying to find areas where more value can be extracted within working capital, I think a lot of that would be around process discipline and controlling that discipline within companies. And increasingly technology might be deployed to this end as well. And the smarter it gets, the more helpful it can be at helping people to effectively deal with processes in an increasingly agile way.
Do you think those solutions are coming from the traditional players in the market, or do you think that it's really the FinTech and younger, maybe not the younger companies, the new companies are disrupting it? Or do you see those solutions providing the existing providers?
An interesting question. I think there are existing providers that have done a good job. And, there are some quite impressive companies that maybe a few years ago would have been called a startup, and these days they're kind of becoming increasingly seen as incumbents. But inevitably, there's a lot of scope to kind of improve things, but also just approach things from a slightly different perspective. And I think that's what a lot of younger companies are doing, is they are trying to take some of these business models, find areas where perhaps there's scope for improvement and for just making it, making it more suitable for the way that people work today as opposed to 10 years ago.
So what are those? Can you give an example of like the kind of methodologies or tools that were typically employed for working capital management in treasury departments, which perhaps now are less easy to use or less effective, or archaic even?
Yeah.
What tools are those?
I think if you kind of look at those situations where people try to make incremental improvements through a kind of pre-existing technology, accounts payable systems are a good example of that. So, 20 or 10 years ago, people were trying to essentially digitize a process which used to take place across email, Excel spreadsheets, and the like. Today, people are thinking to what extent these processes require nearly as much human input as they did 5 years ago. And so people are asking themselves questions about to what extent is human involvement here useful? Is this a case of further digitizing this, or is it actually a case of just automating it away? And conversely, I think that leads to the second question, which is where's human time best spent? And oftentimes that's around managing processes which kind of come before this execution side of accounts payable. And that's where we see probably a little bit less kind of pre-existing activity and pre-existing providers in that space. But we expect that this probably going to only grow.
Being corporate treasury 101, and I think conversations so far has been quite non-101, which is nice as well. And your accounts payable systems, if we just break that down for a second, because it's interesting that you say that that's really one of the big opportunity areas, is typically inside a company, you would have like an admin sitting and like really paying all the invoices to all the suppliers manually, meaning logging into a bank account, putting in the details of the receiving bank account, and then clicking send, right? Is that those are the kind of processes you're talking about? Is it as basic as that, or?
Yeah, pretty much. To a large extent, it boils down to exactly that. There's, a little bit more work to be done than purely logging into bank account portals. You'll find that account payable teams often kind of manage the entire process of ensuring that invoices are legitimate and that they also are as they should be in terms of structure, amount, and so on. And I think what you then find is, to what extent this, for example, verification and governance function of accounts payable is necessary versus, for example, this kind of simple execution side of it, where you just click a number of buttons to make a payment. Yeah, I think people increasingly argue that the governance side is naturally sitting with people, whereas the side of logging into bank accounts is perhaps less, because there's just less kind of value being added in those final activities, if you like. But I think, the kind of second interesting question that many people ask themselves if we stay on the accounts payable topic is, how often do you have to do this? How often can you process invoices? Many companies will kind of organize their payment activities into what they call payment runs, when they execute a lot of kind of payments which are due around a similar time, let's say once a week, maybe only a couple of times a month. That inevitably leads to situations where you might end up paying something a little bit earlier than it's due. So it's a good example where technology can step in and help people sort of schedule payments, of which there could be many thousands in many cases, at exactly the optimal date, which again comes back to the point of maximizing cash on hand and effectively reducing your financing expenses.
So what I take from all this, Stefan, is that some companies, and I mean, I can only concur with that, some companies are quite far in the automation process, digitization. Like, we are still at the very early stages of this for certain big corporates, even that it's still very manual, very human-based. So I know there are some steps between this and what I would like to talk about, but I need to ask the question though. There is a kind of a trendy topic lately, to say the least, which is AI, artificial intelligence. If So if we look at really the best in class working capital management processes, systems, and companies that execute that the best, what could be the role of AI? And if we are like 20 years from now, where everybody has streamlined their processes, optimized them, and so on, where does AI fit into all this?
Yeah, we see this as a very exciting space. I think if you asked me 24 months ago, I probably would have told you that it's largely around automating some of those kind of more repetitive processes, like, for example, scheduling payments at the right time. But I think the technology has advanced so much, and also the people's responsiveness to it and willingness to adopt advanced so much that we can imagine a future where AI can actually assist people with also decision making that goes into managing working capital well beyond very simple administrative processes. And we think that, for example, there are very exciting applications for AI in helping people to make sense of all the different sort of data points that they receive as part of working capital processes, and finding efficiencies or inefficiencies that might actually not be apparent to them at all. So we think that AI, could be deployed to effectively become a process enhancement tool as opposed to being a pure automation tool, because probably in the near to mid-time future, we will still have a significant human element in all of these processes. So we think that the space is actually vast.
How far away you think from a Minority Report working capital management kind of processes where you just have to put on gloves and we can, touch holograms and forecast everything and have working capital management enabled through this? Probably a bit far still.
Chances are, a lot of this. One thing to kind of also bear in mind always about working capital is that it's always a two-way process. You always have someone who is the supplier and someone who is the procurer. So to some extent, there will be limitations as to what can be achieved on one side if the other isn't quite as technologically advanced.
No, a lot of sense. So overall, if we had to look at the future of working capital management, but let's be a bit more realistic than Minority Report, in the short, midterm, like 1 to 5 years, let's say, what will be the solutions out there that we'll be able to find to help corporate treasurers and CFOs, help them with their priorities, right?
Yeah, I think it's probably going to be twofold. The solutions to automate some of the processes that are appropriate to be automated will probably become more prevalent and easier to adopt. And I think also we will increasingly see people deploying technological solutions to essentially help with more of a, say, strategical or at least tactical decision making, where those decisions cannot be simply automated.
Okay, so overall, maybe to wrap up on this, what is working capital management and what are the solutions out there? So working capital management is about maximizing cash flow, right? By optimizing your AP and AR processes and making sure that everything around it, inventory management, human resources, whatever that is a cost center, but also the revenues, this whole thing is optimized. Is there anything else that we didn't mention and you'd like to mention in regards to working capital management and the solutions out there right now?
I suppose the one topic that we haven't spent as much time on is the kind of working capital financing side of the equation. There are solutions to help you accelerate your cash conversion using financial products. It's a very interesting space, but it's perhaps slightly less directly related to what we're trying to do at IOR, which is to support people with organic cash generation.
So that will be the perfect transition. But I guess where you want to position yourself at IOR is just before that supply chain financing and working capital management financing. Yeah, super clear.
Exactly.
Sorry, can I ask a question a little bit going back to the AI conversation? Stefan, you mentioned something interesting, which was like, and indeed, like this is something that as I learned about AR and AP, you kind of realize that someone's AR is another person's AP, or in the whole supply chain of whatever it is you're delivering as a good or service. If you had like two AIs, like an artificial intelligence on the AR side and another one on the AP side of that same transaction, and you're both optimizing for whatever you do, like, couldn't there like be a singularity moment in that, like, where, I don't know, both of them like optimize down to an instantaneous transaction that's good for no one, or I don't know, like, would the whole world just blow up if that happened?
Yeah, you're right. There's definitely a competing tensions in these processes. And what you often find is that this is, to a large extent, down to the kind of, let's say, power dynamics between the two actors. So what you find is that sometimes, the attractiveness of things like payment terms or billing terms becomes just part of the value proposition that you're selling as part of your solution. So you're right. It's to some extent, it's always going to be a set of trade-offs. And I think that's why it's also important to remember that it's not quite as simple as just automating processes and being done with it, because it is much more nuanced oftentimes than it might look like.
Yeah, I mean, Guillaume, you always made a point when we were talking about this in our previous episodes around leverage in your supply chain, right? Do you have the leverage, the scale to be able to negotiate favorable payment terms for yourself versus others in your notes? Can the AI negotiate one day? Like, can two AI guys negotiate with each other and come out with a favorable outcome? Because in human interactions of negotiating those kind of things, it's kind of like, okay, one for me, next time for you. We build trust, we build relationships, and therefore we're able to have those, these things foster relationships almost as well, especially in your customers and your clients.
I want to witness that conversation if it ever happens between two AIs. Even though that might be at supersonic speeds, might be interesting.
Yes, it would be interesting to see the arguments that are being used.
Gordon, you're the technical guy in the team. Do you think that you can code in parameters for AI negotiations and leverage?
Which depends if you're talking about narrow AI or within AI, more general AI or deep AI. So initially, these things would probably be constructed with narrow AI. They'd work within a set parameters. There may be some negotiation in there that some leeway that it can work towards, but then it would just back off if it hit that threshold. Whereas with more kind of deep AI that would be driven by a real-time learning algorithm that was seeking reward, for example, what we call reinforcement learning, which we might touch on again a little bit later, which, for example, Google DeepMind wrote a really interesting paper that they published that, reinforcement learning, this idea of seeking reward and being punished by penalty, is what drives, the entirety of learning across, biological organisms. So if you're dealing with that, where it's constantly trying to seek the most reward, it really depends on what kind of, first of all, the policy that's been set for it. So what can it do? But if that's unconstrained, if it has no limits that have been built into it, then it really will just seek the maximum possible reward. So if that involves essentially getting one over on the other party, then it'll really come down to who had the better reinforcement learning algorithm between those two parties when those two AIs are working, against each other. So yeah, it'd be very much like a game. So yeah, it's a very interesting idea.
There's a really interesting story on reinforcement based reward systems, which is like they did the same thing with football robots once, right? And it's interesting because when you code those kind of problems, you need to be very careful with what you reward. So in those football-based robots, they rewarded like scoring goals and things, but they also rewarded touches on the ball. So if you're able to touch the ball, or what they meant to do was passes, but they coded as touches. And these robots were just sitting there, just kept the ball in front of them and just kept touching it like this to like max out the reward system. So I guess it can go wrong as well if you don't set it up correctly.
Absolutely, yeah. And I think it'll probably be a big stimulus to really bringing in regulation as well. There'll be some kind of safety event in some industry where, this will just get a bit out of control. Someone will code it incorrectly, for example, in some way, and we'll have a weird, hopefully not catastrophic, but there'll be some weird kind of event where there'll be some kind of unfairness in the system that will require regulation.
I agree, and I think it's the other interesting topic when it comes to working capital management is there are certain circumstances in which companies might actually self-impose certain limitations to how far they will go. I think a kind of commonly quoted example of this is management of essentially your payables and stretching out payment terms. Which you'll find is that large companies, which theoretically should have a greater negotiating power, often have worse DPO metrics than smaller companies. And that's actually most often due to the fact that those large companies don't want to be seen as unfairly stretching payment terms on their own supply chains, which might have a lower negotiating power. That comes back to kind of people's perceptions on corporate behavior and treatment of your various stakeholders. So whilst financial efficiency is a big driver, you will find that working capital has more facets to it than just that.
Bring us on to yourselves, please. Tell us about Iora as a company. What do you guys, we talked a lot about working capital management today, touched on automation and AI even. What do you guys do at Iora in all of this?
Yeah, thanks for asking. The way we like to describe ourselves is we're building a new and intelligent toolkit to help CFOs and treasurers to manage their balance sheets even better than they do now. And I think it's a bit of a mouthful, but really what we're trying to convey is that we're building a platform that seeks to understand the company's balance sheet profile and then is able to kind of provide contextualized feedback back to users to essentially help them improve their cash operations. And this includes both the liquidity side of this equation, so the cash that you already have on hand, but also working capital side, which is the cash that's kind of in the pipeline, if you like. And we kind of started off with building a liquidity platform. That platform helps companies make the most of the cash they already have. And now we're looking to kind of broaden that to also support cash conversion, but ultimately it just comes back to kind of helping people gain this much more contextualized visibility as to what's happening with their cash flow.
Okay, so super clear, Stefan. Thanks a lot for this. How can you walk us through how it is actually different from the existing solutions, and maybe linking back to what we said earlier, right? What is out there today helping corporate treasurers and CFOs already. How do you guys at Iora make something that will help them in a different way and normally in a better way?
Yeah, no, absolutely. So I think there are a couple of important differences between how we approach this and many others. So firstly, we are really kind of pretty relentlessly focused on making everything we do actionable. What we find is that there are many solutions that are actually really good at sort of summarizing and displaying large data sets and helping people kind of get almost like a bird's eye view of the situation. And we want to take it a step further. So, we actually want to build tools that help people to actually just infer the best course of action based on the data that our platform sees. So it becomes less of a reporting tool and more of almost like a quasi programmatic advisory tool that helps you manage your finances kind of on the fly. And this comes back to the point that you made earlier, which is that a lot of these processes kind of happen minute by minute, day by day. People often look at it from a kind of point in time perspective, which makes perfect sense. But at the same time, we think that today you can do even more, and you don't have to keep looking at something to make sure that you maximize every opportunity to create value. And secondly, the kind of distinction that we see between ourselves and many other solutions is that we are kind of big fans of, let's say, embedded finance as a theme. And when I say embedded finance, just go back to things like embedding payment functionalities in apps. It's actually more about the idea of finding the user, in the environments in which they already reside. So to give you an example, in order to manage your balance sheet, do you always have to log back into an application like a TMS? Or, is it more appropriate that some of these functionalities are delivered to you somewhere else? And, people spend a lot of times in tools like email, Microsoft Teams, you name it. And frankly, we believe that a lot of this information that our platform can ingest and produce back and help interpret, doesn't necessarily need to live just in our application.
You touched a really interesting point here on the fact that treasury analysts and above are not only looking at reporting anymore, right? But this whole real-time visibility, real-time access doesn't need to be just for the sake of it, right? It's to allow better and strategic decision making. So that's a really good point. How, going back to working capital management in particular, how will that help them, the IOLA solution? How will that help the treasury professionals directly in the management of their working cap?
Yeah, so I think you're right. It's the world is kind of getting more and more real time. If you like, the downside of that is that you suddenly have to make a lot of decisions very quickly because you see things changing all the time. Try to think on how that impacts people who work in these fields. They're frankly under like ever increasing cognitive pressure. And we see this through conversations with people we have ourselves. There are actually quite interesting research pieces out there which try to kind of measure the impact of data availability on how people make decisions and, to what extent that kind of data overload might lead to actual adverse outcomes if it isn't being helped in a certain way. Because at the end of the day, the more you know, it doesn't mean that you always will make a better decision. And there's probably a limit as to how much time not only you can devote to something, but also there's a limit as to how much time it makes sense to devote to a certain decision. Because, there's always a trade-off between your own time and other things that you might be looking at instead of that specific thing. So I think, in our case, being able to interpret vast amounts of data that keeps moving fast and fishing out patterns, which we can then present back to people in a digestible way and, suggest to them what kind of action might be necessary based on this new information is very helpful because it kind of turns the tables around and our system almost becomes proactive as opposed to being reactive, the way that many applications in the past have been designed. And then secondly, I think, and this is kind of related as well, is, in the past, a lot of, especially in the context of working capital, a lot of time was spent by decision makers on kind of interacting with these process teams on the ground. And that, to a large extent, this is good because it fosters collaboration. But at the same time, if the kind of intensity of these interactions can increase because there's more information, that's more readily accessible, can we help kind of provide like a bit of a bridge between those two worlds and help essentially, make sure that the processes are managed in a way that ultimately maximizes value.
Super clear. We love to diving into the details and the technical details of these kind of things. Could you take us through like how your platform is able to, well, maybe this is a good way to put it. Could you start with like the traditional way TMS or Treasury working capital system is integrated and how your solution is integrated to enable the more, not only real-time access, but also the insights access? Is it like cloud-based? Is it onboard? Like, how does it work?
It's probably useful just to start with how these systems have evolved over time. So when treasury management systems first came about at any kind of significant stage, let's say 20 years ago, there had been very much kind of desktop systems that you had to install, a bit like all of the software around that time. You would have required a direct connection with a bank that you'd have to establish between you as a TMS company and the bank. And that would probably have not even used modern communication standards. What we're talking about there are things like REST, for example. That's representational state transfer, which is a modern way of communicating between systems. They would have probably been very clunky, using very old-fashioned, protocols. One example is like Edifact. Hardly anyone uses anymore, but there are still some legacy systems that use these really old-school ways of talking to each other. That's how it would have started. And over the years, some companies, some big TMS systems, like Kira, for example, they've built hundreds of these direct connections with different banks, which made them very powerful in the sense that they can directly connect to multiple banks in multiple jurisdictions. However, in, say 2018, this started to change, whereby open banking came along, and that's been rolling out ever since. Whereby it started to become necessary to create those direct connections. You could actually use a single gateway, and which all works around REST principles. So systems communicating in a modern way. And that enables companies like us to not have to come along and create 500 direct bank connections. We can then use connect to many banks using open banking. There still may be a need for direct connections in certain jurisdictions that aren't well covered by open banking, or in certain corporate cases that haven't quite gotten to open banking yet. But it greatly reduces the entry point to connect to banks. So yeah, in summary, that's that we use open banking as our first method to connect, and then we can use direct bank connections because it's just all works around this REST principle, and that's well understood and quite easy to integrate now. And that's how we do it.
How many APIs have you had to make to enable that? Exactly. Or is it something that is quite straightforward to do? Because even if you are linked into your open banking systems, you have to. There's lots of different parts of open banking as well, right? It's not just like you log in and you're in this stream of data that's freely roaming around, right?
Yeah, that's right. It's a good question. So worth mentioning that when open banking came along, initially it was just a cleaner way of essentially banking systems to communicate. But what happened was companies started coming up that were essentially providing a single gateway to access the whole of open banking, or as much as possible. Players there are players like Plaid, Klarna Cosma. In the UK, there's Yapily, and many others. Tink, which was acquired by Visa. So what they do is to make it easy. You only have to talk to one API, essentially. So we use Plaid and Klarna Cosma. We use Klarna Cosma for access to UK, EU, single market. We use Plaid for access to US open banking. So yeah, that's only two APIs that we need to use to actually get our open banking connectivity. So you can imagine that's a much better starting point than 500 direct bank connections. And so yeah, that's our kind of basis.
Could you break that down for us just a little bit more then, Gordon? So as a user of a platform like Iora, right? If I'm sitting in the Treasury department, you are connected to this open banking protocol, which is able to connect to all the external bank partners, other providers. Maybe there's some FX in there, maybe there's some hedging, et cetera, et cetera. How do you then connect to my internal processes, like my ERP, my TMS, if I already have one that's perhaps sitting parallel to yours or something like this? Do I log into a portal and then it's just connected, or how does that work?
Yeah, so ERP systems follow a similar setup. So a lot of modern ERP systems also use these REST principles, and therefore they have their own APIs. They sometimes have a whole suite of developer tools and developer documentation, even sandboxes to enable developers to integrate systems. And these developers could be internal developers at a given company, or they could be technology companies like us. And so what we can do is we can basically follow this documentation and use their tools. But it's worth just mentioning, people might hear this term, it's useful to know. We often call these SDKs software developer kits, which is basically just a way of easily connecting to a system which under the hood uses an API through REST. it just makes it even simpler for a developer to plug into this. So we use these SDKs if they're available, and essentially we can make a secure connection to some kind of system, ERP system, for example, whereby the company, if they want to connect their ERP system, all they have to do is provide a set of credentials, which is normally like a client ID and a client secret. And that allows them to do a secure handshake. And once that handshake is completed, they're then given a kind of key, if you like, a token that they can use. And that token will enable them to access the system and whatever data they've given permission for us to access. So that might be their ledger entries, for example. It might be transaction history within the ERP system, etc. So that's how we do it, basically. It's all using these principles of APIs under the hood.
And just to not scare off our Treasury friends overall, this all happens automatically, right? Like your system is automatically talking to this other system. It's not the person needs to know what a token is and what a secure handshake is. And they have to remember another set of credentials, which is called a client ID, which is separate to their user. And this is all like automatically done when they first boot up the system, and that's it, right?
That's right. Actually, they probably have very little to do this, i.e. we would just liaise directly with their kind of system administrator. So most of the companies we deal with will have a kind of dedicated person who knows this well and is happy to do all this. So yeah, from the kind of treasurer and user point of view, they won't really see any of this. This will just be part of a brief onboarding process whereby we just can make these connections. And then from their perspective, we just want them to be able to see their data and be able to work with their data, be able to link their data. I link banking data with ERP system data, with an existing TMS system data, etc. So yeah, from that point of view, don't worry, there'd be really nothing for them to do. Our whole thing is to make it as simple as possible and to, if anything, make sure that complexity is like buried where it should be, and the end user can just do what it needs to do.
Is there like a prerequisite level of system that a potential company that wants to integrate your system needs to have? Because, I mean, with the number of treasurers, Kima and I have spoken to group treasurers, treasury assistant treasurers, etc. Off record and on record, there's some horror stories out there about like how archaic some systems really are, and the word Excel getting thrown around a little too loosely at times as well. Like, there's like a minimum, I guess, that their system needs to be pre-automated before you add value on top, right?
Well, actually, we kind of target companies that don't actually have a TMS already. If companies already have a significant TMS product, then that's really good. They're probably doing everything they need to be doing. Whereas we actually like to speak to companies that don't have an existing solution and therefore are still using Excel to manage their cash flow, the cash visibility, who are having trouble getting their ERP system data to marry up with their bank transaction data. That's exactly who we would like to speak to, because we can probably solve significant pain there. Essentially, this is quite a manual process in Excel, and can be very tedious and prone to error. And therefore, actually, the less automation you already have, the more we can probably help.
Super interesting. And so, but then tell me about the system that Stefan mentioned earlier around the insights that you're also doing. So you're not just doing the real-time connectivity, etc., that I guess any ERP or any TMS out there could probably start to provide. You guys are also like giving this sort of assistance tool, predictive, or I think the word that you used was insights, right? How does that work? What does that do exactly?
Yeah, that's right. So what we've just talked about, all connecting systems, is kind of the starting point. Just to, you need that to, so it's like the minimum layer you need to start to give some value, and then we want to try and give more value by offering some what we like to call actual insights. So we could tell people that their balance is getting low, and that is a useful alert sometimes, but most of the time people are kind of on top of this anyway. So what we like to tell people about it is that part of our actual insights is opportunities for them to save money, opportunity for them to make more money from their money. And so that's what we're really looking for. So actual insights would be that we've noticed that there is excess liquidity parked in one of your accounts. Let's say you have 20 bank accounts and we've now got them all under one roof. We can see exactly where all the money is. Perhaps a few of those accounts are like trading accounts and there's money coming in and out. And perhaps some of them are more kind of holding accounts whereby money's being essentially stored there. And what companies can end up with is a kind of significant pool of capital. And they might not always know it exactly because they won't have absolute crystal clear clarity over their cash visibility and their forecasting because they're not really sure where everything is and they need to contact 5 different people and log into 20 different systems to work that out. So all of a sudden they may be in a situation whereby they can actually reinvest this excess liquidity into money market funds, which are offering very attractive rates right now. It may be that we can work out if there's opportunities to renegotiate with their suppliers in terms of payment terms. And it may be that we can identify that they have significant currency exposure and therefore looking at hedging would be a good idea. So these are the kind of actual insights that we like to offer. And that comes from analyzing the data once it's all been integrated, centralized. Yeah, that's the basis of what we do.
And that's an automated system. So, I mean, these are the kind of insights a treasurer would be looking at the data, hopefully, and pulling out, right? That you would have a treasury analyst looking at, eventually, you're like, hey, by the way, we could pull all of our cash into this fund instead of borrowing money in this region or in this legal entity that we have. We can just pull cash over from another one and then save cost of borrowing or something like this. But the idea is to really automate these insights. So it's kind of like, what's this tool that, I think it's like these like editor tools. I don't know if anyone's ever used them, like Hemingway and stuff like this. Like you put in the text and then it kind of says, oh, you could do this better and this is a bit complicated, and just a bunch of things pop up and go, hey, you should, replace this with a noun or whatever like this, right? It really like is able to analyze the same way a human does, or has access to more data.
Exactly, yeah. It's kind of a bit like we sometimes use the analogy of a co-pilot. I mean, as a software engineer, we have a lot of tools now that help us with this. For example, I think a popular one right now is GitHub Copilot, which is essentially, it plugs into your development environment, so a place where you're writing code, and you can kind of just talk to it a bit like ChatGPT, and it will kind of just automatically give you ideas or suggestions as to what your next line of code could be, and it really helps with productivity. It means that you're not having to like write out boilerplate that's actually very boring to do. And it kind of just does that for you. You can focus on the bits that matter and making sure it works. And that's kind of what we want to do, is to enable them to absolutely have oversight of all of this and to have the final say of whether money is invested or hedging products are purchased or supplies are renegotiated with. But bring this to the front of their to their mind. It's a behavioral thing as well. It's in a sense empowering them with the insights that they need to know at the right time so they can make the best decisions possible. And they're not just drowned with decision paralysis and drowned with data and manual tasks and moving things around on different spreadsheets and trying to get a hold of different pieces of data. That's what it's really about. It's really about enabling them to be kind of manage their treasury the best way they can.
Another aspect that you often refer to on your website that we'd like to dig into is the treasury policy. So this is a big topic, so we will probably need to have a full dedicated episode on this. But maybe to begin with, can you briefly explain to us what a treasury policy is?
Yeah, sure. It's that's actually, I guess, it's a document which a number of principles that will kind of underpin how you approach treasury management in general. And within that treasury policy, you often find various sections that deal with different types of considerations that you need to have around, let's say, cash and broader or treasury management. It will probably state, what are your objectives, what kind of tools you have at your disposal, how you will make decisions, what kind of governance you put around it. And then very importantly, it will also at least give you guidance as to how to define your risk appetite, your treasury risk appetite. Because at the end of the day, when you think about treasury, it's all about kind of balance of risks and rewards you can achieve. And in a way, like, a well-designed treasury policy kind of acts as your like North Star for your day-to-day decision making. And this kind of goes back to some of the things that Gordon mentioned just now, which is that, our systems are trying to identify areas where we can improve on a kind of continuous basis, because these are life processes that keep changing. And the reason why we like the concept of treasury policy so much, and we essentially allow people to like encode elements of the treasury policy in our platform, is to give our systems an understanding as to what is the kind of risk appetite of a given organization that's using the platform. And, these might be risks related to your liquidity profile, to your FX exposures, to your counterparty exposures. It's a way for us to essentially make sure that we don't apply a cookie cutter approach to everybody and, attempt to create a one-size-fits-all solution. It's really about finding those opportunities and risks that are opportunities and risks as you understand them and as they use them.
That's a super good one. How do you link those two? Do you invite the users to actually draft their treasury policy within the tool? Do you link it with any other document, TMS, or whatever they would be setting up to say, okay, this is our maximum exposure that we are willing not to hedge, for instance? How does that work in the nitty-gritty for the case of IOTA?
Yeah, so we essentially ask people a set of questions at onboarding or around onboarding, or the system asks the questions, and we kind of use the answers that users provide to define that risk appetite. It's quite clean, because it means that you don't have to fiddle with a lot of PDFs but also necessarily worry about elements of a treasury policy that perhaps are less relevant to what our system does.
Okay. And so do you offer solutions in regard to the treasury policy as a whole, or is it only focused on working capital management, or is there like room for scaling up and developing further on that?
Well, there's probably always room to expand. Right now,
it's a sure.
But right now we kind of link it really back to the functionalities that we offer. And we, for example, when it comes to kind of like cash liquidity side of the treasury function, that really is a set of kind of liquidity and market risks that people need to manage for.
You guys also have this section in your literature where you talk about bank concentration risk, right? Which is also a very topical conversation, especially in the US right now, where you've seen three big banks, well, globally seen three big banks fail, regional banks to be fair. I guess it's quite topical, right? Everyone's thinking about, well, am I a startup right now that's got all my money in Silicon Valley Bank that can only withdraw like 250,000 of it, etc. Like, can you talk a little bit more about that? Like, what's your insights or what solutions you provide around bank concentration risk?
Yeah, totally. It's a very, very topical one. We see this as one of the elements of like the market risks that you need to manage for. Yeah, look, it's obviously really unfortunate that there were these events that have made everybody think about it again, and we are sorry to see like some really kind of national institutions get in trouble, right? But it's kind of is a reminder that risk management is kind of about managing for kind of black swan events, in a way, and they do happen, and unfortunately they tend to come about fast and out of nowhere, or at least it might seem like that. But like on a kind of more practical note, if you think about counterparty exposures, this is really just how likely is it that the counterparties that effectively owe you money run into trouble and might not be able to give it back to you. It's kind of linked back to the broader macroeconomic environment we were talking about earlier, and I think it's just another emanation of kind of new risks that kind of raise their head again, if you like. And how do we help people manage that? Well, companies tend to have a policy as to how much exposure they're willing to take to a single institution. If they don't, they probably should. The way we've set up our platform means that even if, as an organization, you haven't thought about it before, we can essentially help you think about it now. And then we track this exposure on an ongoing basis. And if you kind of deviate for some reason, then we'll let you know so that you can rebalance your exposures. And we're also able to kind of make use of the fact that this is a computer system, so it's pretty good at pushing out information like things like ratings, things like regulatory designations from different banks. So you don't have to think about this kind of stuff all the time.
Makes a lot of sense. Guys, thank you so much for coming on the Corporate Treasury 101 podcast. Is there anything else that you want to add about IORA or working capital management or the future of working capital management?
Well, I mean, firstly, we also wanted to thank you for hosting us today. We really enjoyed the discussion. I mean, just to summarize, we think Treasury is a very exciting topic, and
likewise,
we just also wanted to remind everybody listening that Treasury is not just a big company topic, and no matter how big or small a company is, they inevitably will have a treasury function, even if there's no separate team to manage that. And no matter how big or small, you need to think about these problems, these risks, and also opportunities that this function kind of entails. Oftentimes these problems appear to be small in isolation, but it's kind of all about maximizing these marginal gains and avoiding extreme risks. It adds up, and there's actually also what machines are pretty good at. So yeah, that's kind of a little summary. And, it's want to learn more about us, then obviously head to helloiora.com, it's our word, or hit us up on LinkedIn. Both Gordon and I spend probably a bit too much time on LinkedIn.
It's good. Everything related to that will be in the show notes below. So anyone listening can go down there and find either Gordon or Stefan's LinkedIn profile, or also the Hello IORA website link as well. Guys, appreciate you a lot for coming on, and all the best with the company.
Thank you very much. Thanks for having us.
Thank you.
Awesome.
Bye-bye.
Thank you so much, guys.
Cheers.